So good morning again and welcome. My name's Tom Bayer. I'm a partner with Sikich in the Indianapolis office. With me today, I'm joined by Jim Brandenburg, a partner in our Milwaukee office. Good morning, Jim.
Morning, Tom.
Morning, and also Glenn Birnbaum, who is a partner in our Peoria office. Good morning, Glenn.
Hi, Tom.
So a couple housekeeping notes here, and we'll get started. We do have a pretty full group today. We encourage you to submit questions to us via the question feature in the webinar control panel. We are anticipating a lot of questions, so we'll try to get to those. And if we can't get to them, we will submit answers after the webinar. The presentation slides, you probably can see those in the control panel there. You can download those or a few other handouts as well. So, and then we also are offering CPE credit. So you will need to answer the polling questions. And then we will also have a short survey after the webinar. So you need to complete that survey and that evaluation to get a CPE certificate, and the certificates will be mailed out within about 2 weeks. So with that, today's presentation, we're going to focus on a couple main topics, the employee retention credit and some updates. And then we're also going to get into the American Families Plan and that proposal and some of the key points in that proposal, which is not yet law. So, and we'll also talk about some COVID-19 developments, and hopefully we can get to some of your questions today. So again, please submit those questions. So Glenn, do you want to take us into some of the employee retention credit slides?
Yeah, thanks, Tom. So yeah, I'm going to be speaking about the employee retention credit, and I know we've done a few webinars on this already, but the last one we did was in February, so we kind of want to update the audience for a few things. And I will go ahead and say we do have extra slides in the presentation that we're going to kind of skip through just in the interest of time, but we didn't want to cut them out totally just to have as a good reference, because I think sometimes we find that we need kind of a refresher on this employee retention credit. So we will be going through these slides, some of these slides pretty quick, but we are going to talk specifically about some of the changes with CARES 3 and how that interacts with the PPP. And then the last bullet point there on this slide, we're going to talk a little more specifically about how do you actually monetize this credit, a little more of the practicality of the employee retention credit. So next slide then. Okay, so this slide here, this is kind of a big picture overview. We're kind of calling it a 4-step process, or maybe just, hey, these are 4 things to really keep in mind if you're looking at the employee retention credit. Number 1 is the affiliation rules, that you've got to look at controlled group rules, affiliated service group rules and things. You have to make sure you really focus on that initially before you get too far into it. Obviously, the eligibility is primarily these 2 doors, door number 1 being the significant decline in gross receipts, door number 2 being the full or partial shutdown. We've got a few slides on that later. Am I a small or am I a large employer? That's a very big deal. And if I'm a small employer, remember, I get this credit on all wages paid, versus if I'm a large employer, it's just going to be, wages. I'm paying wages to somebody not working. So it's a very big deal. And then the last point is, okay, how do we calculate it? It's $10,000 of wages per employee per quarter now for 2021. And the credit is 70%. So it's a very big deal. So next slide, then, Tom. This is just a little more detail on the affiliated service groups when it comes into play. Not going to talk about it much, but just use that as a reference as we go to the following slide. This one is just talking about a little more specifics about how we might qualify for it. You do have to be a trade or business. We'll move to the next slide then. Remember, it is 50% decline for 2020, 20% decline for 2021. So we'll move to the next slide. This is a slide I do want to focus on. This is one of our more common questions that we get. Okay, which quarters do I look at, right? It gets kind of confusing because we do have this alternate quarter rule. So, hey, we're in the Q2 right now of 2021. I look at my Q2 2021 revenues, which I don't think we know exactly what those are, but you would look at your Q2 2021 revenues as compared to Q2 of 2019. So it's a 2-year look back. Or I can look back to just the previous quarter. So I looked at Q1 of 2021 as compared to Q1 of 2019. Okay, so it's a 2-year look back for 2021. It's a 1-year look back for 2020 if you're going back and trying to claim credits for 2020. So that's a key slide to mark and refer back to later. We've covered these examples, so we'll just skip through these next few slides here, Tom. In the past, good reference point here. This one is that previous one was talking a little bit more about how that alternate quarter rule works, but it is possible to get the credit for a number of quarters. So definitely look at that one at your convenience. So moving to the next slide, this is talking about the partial suspension. What's considered a government order. How does this all work? This is, if you remember, this is the more squishy topic of you have the more solid one of a revenue decline, right? That's more black or white. This is more the squishy subject of what is considered a full or partial shutdown. So if we look at the next slide, I do want to focus on this because this is something new that's come out since our last webinar, which was in February on this topic. We have this notice 2021-20 that came out from the IRS. And if you remember, there was a bunch of frequently asked questions that the IRS had put on their website. These were non-authoritative. Well, now with this notice, they put in 71 questions and answers into this notice. And so now this does provide some authority that we can rely on, what's in here. So nothing extremely earth-shattering in here, but some of the key takeaways, those 4 bullet points down below, it talks about what's the meaning of nominal. There's a 10% safe harbor. We've got a couple slides on this coming up. What do I mean by comparable? In other words, is it operating comparably post-COVID as compared to pre-COVID? How does the ERC interact with the PPP? And then they also, clarified that, hey, remember, this ERC is considered taxable income. So do keep that in mind. So if we go to the next slide, then just want to talk just very briefly about this. This is this more than nominal size test, it's called. And this is, what if I have a portion of my business that's been suspended? Okay, but I have a lot of my business that's operating, maybe normally, and they get into some specifics here, and I would encourage you to look at this question 11 if you have this situation. But they talk about looking at, revenues or looking at hours, a specific metric to see if this portion of your business is more than 10% or not. And do keep in mind, this is just a safe harbor. It doesn't mean that if you're at 8 or 9% that you couldn't still qualify for this. But that is one thing to look back to is, again, question 11 in this notice. And then if we go to the next slide, this is a similar concept, but they don't get into near as much specifics about how you actually compute it. But this would be, okay, I'm operating my business. It is continuing to operate, but there's restrictions on the ability for my business to provide goods or services. And is it sufficient enough that it's going to more than nominally impact my business? Again, that is question 17 and question 18, if you have that situation, but not as clear on how you actually apply this. So that's the kind of the more recent guidance that's come out. It's been since early March that it came out. So now we're kind of back to, what is step 3 about? That's just, am I a large or a small employer? Do remember it's based on your 2019 employee size, and it's not the same calculation as PPP. It's based on the Affordable Care Act rules, so it's kind of a 30-hour-a-week test. So that, again, it's really important. If you can meet that small employer size, the credit is a lot more significant. So let's go to the next slide, Tom. And this is then our final step 4 slide. And ultimately, when you're doing this calculation, you have to look at wages by person, right? Because ultimately you've got to get that specific. Even how does it cut off in the quarter? in the pay period, those types of things. So you got to get specific on this. And now for 2021, it is, potentially up to $28,000 per employee for the entire year. So it's very significant. Okay, let's go to the next slide then. Just a quick follow-up here. What I haven't read, there was some question about this, months ago, back in January, about how this all works. But now it's rather clear. I think everyone's pretty much in agreement on this across the tax community, that, related party wages, and if you own more than 50% of the business, then those wages are not going to count. Your spouse's wages aren't going to count. Despite what the frequently asked question number 59 says, you have to look to 267C. So we'd like to see the IRS come out with some guidance on this to super clarify it, but it's been over a year that we've had this ERC and they haven't clarified it. So at this point, that's our best read of this, is that those wages aren't going to count.
Okay, so we have a poll question. Our first poll question, Jim or Glenn, would maybe one of you read that for us?
I'll read that here. I'll read the first question here. Have you claimed the employee retention credit, the ERC, during Q1 of 2021? And the selections here for this polling question: yes, no, unsure, and not applicable. So if you could just take a moment there and please answer this question. Okay, here's the results we've got here with this, the first one here. We've got 18% yes, so it's a good no, 63%, and then a few unsure, and then 15% not applicable. And again, some may, even if they said no with it, again, if they find out they qualify later, they actually go back and amend to get that. So it's interesting to see that we've got some activity here with this ERC. So thank you.
Great. So we got a few changes to the ERC in the American Rescue Plan, or what maybe some call CARES 3. So let's move into those, Glenn.
Yeah, thanks, Tom. Yeah, so this was passed on March 11th, and the big thing is it does extend the ERC through the end of the calendar year here. So we have it now available potentially for the third and the fourth quarter. It does put in some new kind of features for a startup business, and also for what's called a severely distressed business. This is only for the third and fourth quarter. The other thing it does is it does expand or extend the normal period of time that the IRS can audit and issue assessments. So instead of it being 3 years, they're now going to say it's, they're going to have 5 years to go back and review these. So certainly, something to keep in mind. It's quite a long look back period for the IRS to scrutinize this.
Hey, Glenn, maybe one question. You talked about, had a question come through here. You talked about limitations on which owners' salaries and then family members qualify. So I'll read this question to you, and maybe you can address it. How to handle S and C Corp shareholder employees? Can 50% owners and wives employees count? Wife employees count, right? So right. And then second follow-up is, how about a 49% owner? How about, say, 100% owners? What are you telling your clients? So I think maybe you can address that just broadly.
Yeah, we kind of, we did talk about it a little bit, but just because the frequently asked question 59 does not mention, the owner and the spouse as a related party, under 51I is the reference, and the actual bill says it's use rules similar to 51I. So it's actually not even clear what rules we should use. It says use rules similar to 51I. The IRS has not covered this, but also in 51I is a reference to 267C. And that's where, if you're a more than 50% owner, you're out of luck, and also considering your spouse. So that's the best read we have right now. If there's, other specific questions, we can talk about them, but you got to be careful about that frequently asked question. It's a little bit deceiving.
Okay, thank you. The other question, I think maybe we could jump into pre-tax health plan deductions. Are those considered qualified wages on which the ERC can be computed?
I'm not exactly sure I know what that means. Maybe if somebody
Well, I
can.
think what it means is the employee employee pre-tax deductions. So maybe HSA would be an example of that.
Right. I don't know offhand. I can hazard a guess, but yeah, I don't, if anyone else knows specifically, Jim or.
Well, I think pre-tax deductions really would be wages, I
Could
would
be wages,
expect,
okay.
and so those
I would think,
wages
right?
certainly would qualify. The health insurance that's qualified is really employer paid health insurance, right? So if the employee pays part of it, that's really part of their wages, and they've elected that. So that's really, I think that's the answer. We can follow up on that though later.
Right.
Thanks.
Okay. Okay, so comparison of ERC and PPP loan, and I will throw this question that came earlier in, and I think you're going to cover it, but I'll go ahead and throw it in while I've got control here. Employee has 10,000 of wages, they get 5,000 of ERC. Can they use the other 5,000 of wages that wasn't claimed, the credit wasn't effectively netted against? Can they use that for PPP? That was one of the questions we got, Glenn. Does that make sense?
Glenn heard that, Tom.
I don't think you got it. Okay, so I think the answer to that is no. The 10,000 of wages that earned the 5,000 of credit can only be used once. So I think so you can't use those wages for both, even though you really only netted a $5,000 credit benefit. Glenn, do you have the next slide? I think we may have lost. I think we may have lost Glenn. Nope, we lost him. I think he has a.
I'm back now.
Okay.
I don't know what happened, but.
So on the ERC and PPP loan, both are still available. Both available for 20 and 21. Obviously, you had some caps on the PPP. There's no cap for ERC. The small employer max of 500,000 in 2020 and 14 million in 2021. So quite a, as we've talked about, the benefit in 2021 is a lot higher, right? So in bold there, ERC is refundable payroll tax credit. It's important to remember. And then, ERC is also treated as taxable income, whereas PPP can be forgiven and is not. So remember that, $500,000 of employee retention credit is going to increase your taxable income. So that's a major difference. And in your materials there, the PPP loan and ERC, we have a comparison chart. I think we've sent that out before. So refer to that tool as you need to. It's a pretty good tool to kind of compare and contrast. So, all right. And Glenn, you want to cover maybe some more of the interaction?
I don't know what happened there, but yeah. So these next few examples, and we don't have time to really get into them specifically, but we wanted to provide them as a reference. It's just how does the PPP, interact with the ERC? And just to cut to the chase on this, if you have a $100,000 PPP loan and you put $150,000 of wages on the PPP forgiveness application, the IRS says you can use that extra $50,000 of wages that you didn't need for PPP for ERC. So that's a good thing. Conversely, though, let's say you had $25,000 of rent that you could have put on that form as well, but you didn't, just because I don't need to. You thought no worries, don't need to worry about it. the IRS says you cannot use that $25,000 of rent that you could have put on that PPP forgiveness form. That does not free up an extra $25,000 of wages for the ERC. So you're kind of out of luck if you didn't put things like rent or utilities on there. Now, maybe it doesn't matter, right? Because, you know, you've got to ultimately look and see, you know, am I going to come up against the caps on the ERC? But it's kind of some good and some bad with what the IRS came out with in those examples. And so we'll just kind of skip through these examples. You can read them at your leisure, but we did provide 4 examples coming from that notice.
Okay, well, we came up on our second poll question already. Glenn, you want to take that?
Yeah, so this one is, you know, do you believe you're going to qualify for the ERC in Q2, Q3, or Q4 of 2021? Saying, you know, either yes, no, unsure, or not applicable. So this is kind of looking forward to Q2, Q3, or Q4. So if you could please respond to that question.
Hey, Glenn, while they're responding, do you want to talk to just sort of maybe a planning tip around as you go through the 2021 year? And of course, we're in May, we're close to the second of 3 months in the second quarter. What advice would you give, you know, the folks on the webinar about just kind of looking at their revenue so far this quarter and planning ahead?
Yeah, I think you hit it there. Is you need to know what your quarterly revenue is, you know, starting in 2019, and it's a good thing just to track, and because you may forget, you know, what a certain quarter was back in 19 or in 20, whatever year it might have been, and so you just know your numbers, I guess, is the tip. Make sure you know your numbers and see, you know, how close you might be, you know, to that 20% threshold as we go out here. Okay, so it looks like poll results are 28% yes. Again, this is for Q2, Q3, or Q4. 26% no, so pretty evenly split there. And then 34% were unsure. So good information to have. Definitely seems like more people may be, you know, thinking they're going to qualify going forward here.
Yeah, I had one customer I had that conversation with about just looking at each quarter, and they reference back to 2019 and say, oh yeah, we had a huge third quarter in 2019. So, you know, it's very unlikely that the third quarter of 2021 will hit the revenue number. In fact, we'll probably be below 80% of that revenue. So, you know, be cognizant of that and don't miss that opportunity. So.
Yep. All right, thanks, Tom. So this is kind of my last part, and this is kind of getting to the specifics of how do we capture, how do we monetize this credit, and want to give special thanks to Angie Vaughn from our Peoria office and our payroll area who helped me on these slides. But this is, you know, it's a payroll tax credit, okay? Not an income tax credit, and so there's different ways you can actually monetize, get this money back. One way is you can wait until after the end of the quarter and, you know, and claim it on your quarterly 941. So that's one way you can do it. If you've already passed that time frame, right, you can go back and do an amended, or it's called a 941X form. So you can go back and, you know, get the money. We've got some future slides on this. You know, you can also, if you know you qualify during the quarter, you know, maybe because of that alternate quarter election, you already know you're good for the quarter. You can, you know, offset it against your current, you know, tax obligations right now, so you can effectively kind of get it back by not paying it in the first place. If the amount is in excess of that, then you can actually file this, what's called a Form 7200, which my understanding is you can file this as many times, you know, as you want in the quarter to get this money back quicker. And we're going to talk about that in the next few slides too. There are some more specific question and answers in that notice that you may want to refer to, and then obviously you do need to keep this, you know, you need to substantiate all this and keep this around, you know, so have good documentation of why you qualify and how you computed everything, of course. So the next slide here, there was a new draft 941 released just yesterday morning. It has some additional lines on there. It's got a new line for how much 7200 advances that you've already received. It's line 13H. So again, it's not officially out yet, but it was draft form just yesterday. As of right now, there's no way to file a 941X, at least last time I checked, electronically. So that would be, you know, a paper document. You got to rely on the mail system for that. As you're doing your 941s, this gets a little bit in the weeds here, but you know, the Schedule B really, it actually should match your line 12. So you may just want to make a little asterisk on this point. You know, Schedule B should match line 12 of the 941. It is not the deposits that you've made. We have seen some companies are still mailing in their 941s, you know, versus maybe should you electronically file your 941s. So you know, something to consider there. And then, you know, a common question we're getting, and certainly I would be interested in hearing, you know, what others in our audience have experienced is, okay, how quick do I get this money back, right? And that's probably my most common question. And, you know, don't know that we have all the answers to that. We've heard for an amended, you know, for a 941X, when you're going back into 2020, that could be, you know, 6 to 9 months. Again, I'd be curious if people want to chat in, you know, maybe their experience of that. Certainly, we think it's going to be less than that if you're talking about a, you know, a 941 for a current period, or maybe amending a 2021 quarter. But again, with it having to rely on the mail system, it's not a quick process to get this money. So do keep that in mind.
Hey, Glenn, we did have one person ask that very question. You know, what's been our experience so far with our clients in terms of getting refunds back on the employee retention credit? I don't know if you guys have any insight on that.
Yeah, nothing. I mean, we've had a few people do it, you know, for the first quarter, you know, claim it for the 941. To my knowledge, they haven't received that money as of yet, but
Right.
to be determined on that. I don't know, Jim, have you heard anything?
I've said the same same experience that you've mentioned with that, Glenn. So
Okay.
several
Okay.
have applied and haven't received it yet. So
Yeah.
Yeah. Okay.
So last slide here, this is this Form 7200. This now can only be used for small employers for 2021, so do keep that in mind. Although I'm not sure, you know, it's particularly going to be that helpful for large employers because, you know, remember, if you're a large employer, you're only going to get it for wages. You're not, you know, you're paying somebody for not working, so maybe kind of a moot point. But there is a new 7200 form out that came out earlier this month. It's called the April revision, so do make sure you're using the right form if you are going to try to use this form. In the instructions that came out, just kind of put in some of the quotes. You know, this kind of gives me some caution here. It gives me a little bit of heartburn because they're saying, you know, hey, it's possible that we may not process your 7200 form. You know, even though you sent it in earlier, I guess, until, you know, prior to when they process the 941. So, you know, be careful. And they're not going to obviously process the 7200 if they've already, you know, processed your 941. And then this is probably my most concerning point is, hey, this is the IRS saying this, you know, we're going to correct this and we'll adjust it, this new line 13H to what, you know, we think it should be, or we'll contact you to reconcile the difference. So, you know, if you have this and you've got multiple 7200 forms, it just gives me a little bit of heartburn that, you know, there's not going to be some confusion here and it could delay the process even further. So keep that in mind on the 7200 form. It is able to be faxed in though, so that is different. You can fax it in, and the last day to file that form for the second quarter here that we're in now would be August 2nd. So just a little bit of caution on this form if you're going to try to use it.
Great. Thanks, Glenn. So we have a few really good questions. I'm looking through here on some more specific questions on ERC, but we're going to jump right into the American Families Plan, and if we can cover some of those at the end, we will. But I want to make sure we give Jim plenty of time to talk about the American Families Plan. Jim?
hey, thank you, Tom. Thank you, Glenn. And again, it's great to cover the employee retention credit. I think there's a lot of opportunities for companies. Again, especially for some that you know, took the PPP loan last year. Some are revisiting now this retention credit, so it's a great opportunity. At the same time, we're looking at that. You know, we've got this new America's Families Plan proposal that's out there, so we're going to talk about that here, you know, this morning. And again, what we're looking at with this is a proposal. Again, this is the administration issued this, and it's referred to. They're looking at a a business infrastructure bill, for roads and bridges and other items, but this is sort of they've referred to as a family infrastructure, a spending plan for individuals and families that the administration has. So we have the American Jobs Plan, which is going to be paid for with tax hikes on businesses. But this American Families Plan, again, focuses on relief for families. It's about a $1.8 trillion plan, $1 trillion of it coming from investments that, again, to assist workers and their families for preschool education, college, nutrition, and other programs. And then there's another about $800 billion that would be tax credits for families, enhance the child care credits, earned income credit, several other items. What they're going to do with this, separate from the rescue plan, is they're going to, quote, pay for this American Families Plan, and that's going to be with some additional taxes for individuals. And that's about $1.6 trillion as part of this plan. So anyway, that's what we're going to cover today here, is just go through some of the changes that the administration is proposing here, walk through what those are, and then also cover maybe even some observations and some planning thoughts on that as we move down this process of this new legislation. And then we'll also talk about a couple items that were not included in this American Families Plan, that there was speculation they'd be included in there, but they were not. Here's a couple of highlights that were in this. And again, this was not a real detailed proposal. Again, it did offer some higher level items that are being included. The administration and the Treasury are going to release a few more details of it. They said here shortly, perhaps by mid-June here with it. They'll provide a little more details with it, but these are the high level what they included. First is some higher individual tax rates. Again, they're going to undo some of the tax reform changes for some of the tax reductions there. Higher tax on capital gains and dividends. There'll be no step up in basis at death for appreciated property. Like-kind exchanges will be limited. The large loss limitation that came about from the Tax Cut Jobs Act will be made permanent. The net investment tax, the 3.8% tax on income, that will apply for individuals over $400,000 of income. That it's going to remove an exception available for those that are involved in the business who've been able to avoid that net investment tax. That's going to be removed. And then the last item included in that is some additional resources for the IRS to expand their enforcement, audits, and compliance efforts. So we're going to touch a little bit on each of these points that are included in the bill. What I just wanted to mention, just for your reference, is some of the items that were not included within there. That were speculation. These were going to be included, but at the end did not become part of the American Families Plan. But at the bottom, just note that some of these items, while they weren't part of that, they could still end up being introduced by Congress or added to other legislation too. So there's no limitation on itemized deductions. The qualified business income, the QBI deduction, 20% that many are familiar with. There's no limitation with that. There was some talk of higher payroll taxes, sort of a donut tax that would apply for some payroll tax that was not in there. One of the main things was the state taxes. They were looking to reduce the exemption with it and increase the tax rate. That did not happen with it. So that's something to, again, keep an eye on. There was some talk of triggering this tax of appreciated assets at death. That did not happen. Again, there's some talk that may get, perhaps at least brought up again in Congress. Other talk was of a wealth tax, just based on the wealth of or the value of assets that you have, that there'd be some tax on that on an annual basis. That was not included. And then one that would kind of go the other direction to provide an offset or benefit for some would be either remove or soften, lessen the Tax Cut Jobs Act, the $10,000 limitation on SALT deduction for state and local taxes. There's been some discussion to reduce that or eliminate that, perhaps even, but that did not end up in this bill. But there's pressure in Congress now, if they do move a bill, to put something in to soften or remove that SALT limitation. So again, these are some items that were not part of this Families Plan, but something to keep an eye on. First, this is higher individual tax rates. Again, these would undo some of the lower taxes that came about with the recent Tax Cut Jobs Act. In the 2017, that top rate was dropped from 39.6 down to 37. This Families Plan would push that top rate back up to 39.6. So the 37% rate that we have now, again, applies for taxable income of $550,000 for married filing jointly and $400,000 for single taxpayers. It's unsure exactly where this new 39.6% rate would apply. So it's one thing that wasn't spelled out specifically. So something to be aware of. The one that's got a lot of attention is this higher tax on capital gains and dividends. The current rate is 20%, plus there's the 3.8% net investment tax, so it effectively gets that rate to 23.8%. What this new law would do is if income is over $1 million, it doesn't really describe what that $1 million would be, whether it's taxable income or capital gain income, but it's $1 million it mentions. What they would do is treat capital gains and the qualified dividends as ordinary income and tax it at that new high 39.6% rate. So it would increase that. And then if you had the 3.8% net investment tax, you got a marginal rate on capital gains and dividends of 43.4% to the taxpayers that would apply to. So it's really essentially doubling that tax rate. So that will have a significant impact on investing and tax planning. We'll talk about that in a little bit with some of the planning observations. Next, there's going to be many familiar with, there's what they call a step up in basis to the fair market value at the date of death for appreciated property. So when the heirs get that property, when they dispose of it, there's no capital gain tax disposed of that on that property. This has been a long-standing provision in the tax law that you have this in there, and it's used in estate planning. What the new law would do is it'd be $1 million exemption per person that you would have with it. So what that would entail is you could have $1 million that could be exempted, but after that, it would be a carryover basis that would apply. That'd be per individual. So if you had a married couple, they would have $2 million. And then I think that the Treasury and the administration has mentioned is that you would also get the up to $500,000 on your residence, your principal residence. So you could get potentially up to $2.5 million. Again, much less than is available presently. Also, one thing just to note, what the this family plan outline mentioned is they would include protections, and I put that in quote, so that a family-owned business or a farm would not incur a capital gains tax if this business was transferred to heirs who would then continue to run that business. Unclear exactly what would be involved with that, but it seems to be that they'd provide some type of relief that would be included from this capital gain tax, so that you know, if you transferred the business, continued on with it, you could do that and get some type of step up or protection to not incur this tax. So something to be aware of, to watch what they will include with that. Like-kind exchanges, the administration had talked about this even last year during the campaign, is to get rid of like-kind exchanges or limit them. Again, under current law for real estate, not a personal property, but real estate, you can exchange that if certain rules are met. If you identify the replacement property and complete your exchange within this certain time frame, you can avoid recognizing gain on exchanging real property. And that gain is in effect deferred at the basis that you would have recognized rolls into the new property, but you don't have any tax paid with that. So like-kind exchanges or Section 1031, very common in real estate and has been for a number of years. What the new this proposal would be, this American Families Plan proposal would limit the like-kind exchanges to $500,000. What they didn't really spell out though is that a $500,000? Is that per trade or per disposal, or is it per year? Is there any phase out with it, or is it a lifetime? They really didn't provide details with it, but just to indicate that there'll be some limit to $500,000. So something to be mindful of with those in real estate who have used this like-kind exchange provision before. Next, thanks. Okay, another one that came with tax reform is a new limitation, what they call a large loss limitation. What that does is it put in a $500,000 limit that if you had a large loss from a business, even if you're active in the business, they were going to limit it to $500,000. Any excess on that would carry over. When the pandemic came on last year, the CARES bill kind of put that limitation that didn't apply for 2018, 19, and 20. It starts up again here in 2021. So we didn't have this limitation apply in the last several years. It starts up again in 2021. This would extend, it extends out through 2026. Well, this proposal and this family's plan would make this permanent. So it's something to be aware of. Next, I mentioned before this net investment tax at 3.8% tax. Again, it applies, but not in all businesses. So if you're actively involved in a business, this tax does not apply to the individuals that don't have that. What this change would be is with this American Families Plan would be that for those making over $400,000, this 3.8% tax would apply on that. So regardless of the nature of the business or whether the individual is involved or not, that 3.8% net investment tax would apply. You'd still have a benefit if you were making less than $400,000 to take advantage of not have that net tax, that net investment tax apply. But once you're over $400,000, this tax would apply. Okay, and the last item just to mention that's in a proposal, and one thing I think it's kind of interesting that over $700 billion, or almost half of what they projected revenue that they're going to get in this American Families Plan, the tax revenue that they're looking for is coming from additional IRS enforcement provisions. So they're going to look at more audits of higher income taxpayers, but this could fall on taxpayers earning less than $400,000. So the talk has been is that most of these tax increases are going to fall on taxpayers making more than $400,000. However, this IRS enforcement, again, if they're going to look at closely held businesses, partnerships or S corporations, C corporations, that could fall on taxpayers making less than $400,000 when they take those additional enforcement actions on there. They're going to look at pass-through entities, again, S corps and partnerships, LLCs, any foreign activities that you may have, trusts. There's some other areas. And the next slide, Tom, too, one of the other heightened areas this last number of years and will be increasing focus is on cryptocurrency reporting. They're going to look at that, some additional reporting compliance that you have with that. One other thing that the administration has talked about is some enhanced reporting and some additional matching. They're going to have more matching forms to issue out to taxpayers, and then you reconcile those on your tax return. And one of the things they've talked about is getting additional bank records of taxpayers and reconcile what's in your bank records to what's on the tax return. Many of businesses and individuals are concerned they having all their tax records or bank records sent to the IRS and then have some big reconciliation on your tax return to reconcile what's included in your bank records with what's actually ended up on the tax return. And a lot of this stems from, there's been several reports recently. And again, this is not new. I recall back, this is probably 8-10 years ago, they talk about this tax gap, that there's additional money that apparently that Congress administration feels is not getting reported and picked up and paid tax on. And they're targeting trying to close that tax gap of actual reported or earned revenue with what's actually getting paid in to the government with it. And they've had another study that shows that, so that they think that this additional reporting will help narrow that tax gap. So they think this will be provide again about $700 billion with it. What it'll come with was additional reporting and record keeping. And again, a lot of that burden is going to fall on taxpayers that are already compliant, that are already filing their returns, they're already paying all their tax, but they're going to get the impact of having to file some of the additional forms with it to report that. So that's something we'll have to keep an eye on. There's been some discussion with it, and we just don't know the details of that at this point. So we have our next poll question here. Glenn, you want to handle this here, just to take a look at this here?
Yeah, so this question is, hey, are you considering accelerating income into 2021 as a result of proposed higher tax rates, for the AFP plan? So please answer either yes, no, unsure, or not applicable. So is this going to cause you to accelerate income into 2021?
Jim, on your last slide, while we're waiting for those to answer, you mentioned bank statements, which is a very, in an IRS audit, especially on individual returns, very common for the IRS to reconcile, receipts on a bank statement back to, to tie out the wages and where receipts are coming from. And one of the, another practitioner I was with, will file gift tax returns even if the gift is below the threshold for parents, just to document if there's receipts that aren't accounted for. It documents in their children. In this example, it documents where those receipts are from. So it's an interesting point in terms of what the IRS is looking at for enforcement.
Yeah, it'll be interesting to see how specific they're going to have with that here. Good question though, Tom, to see what the details they're going to look at. Here's the answers on this poll question is, as far as accelerating income to 2021, yes and no about split, about 25%, 26% no, unsure 37%. Again, probably waiting to see what's going to happen, and then 12% not applicable. Okay, thank you for responding on that poll question here. What I'd like to turn to now is, again, just first some legislative comments on this change, and then we'll get into some observations with maybe some planning thoughts with this proposed American Families Plan. Again, this is just a proposal that now it needs to navigate and work through Congress. As many of you know, Congress will put their own plan together, which again could differ from the administration's plan. They're going to try to craft a bill that can survive. They've got very narrow margins in the House and the Senate. The administration is, so with any bill that would get through Congress in the House and the Senate, the administration is going to have to accept, even if it differs from what their initial proposal is. It's uncertain at this point as if what they call this budget reconciliation will be used for the American Families Plan. If it does, they only need a simple majority in the Senate to push that through. If they don't use budget reconciliation, they're going to need 60 votes in the Senate to pass it. So they'd have to get some type of bipartisan effort with it. The passage of this bill is unclear at this point. Again, not only do we not have all the details of the plan, but whether or not it will pass. And the other thing that we'll talk about briefly too is, even if it does pass, there's a lot of questions too. What are the effective dates and all these changes? So a number of items that are up in the air, but we just wanted to make sure that you're aware of this, that nothing is final now with it, and the dates aren't final. So what we're going to look at now is just some, what I put down is practical and planning observations. These are just some items to consider. Need to monitor the legislation, the details, watch these effective dates, perform some analysis, do some modeling with it, either yourself or get your tax advisor involved to help with it, and determine the best course of action that you'd have with it. Other planning ideas may be available. This list is not all inclusive. It's just a sampling of some items for you to be aware of and start thinking about. The first is just entity selection. Anytime you have a change in tax rates, everybody wants to look at, should you be a pass-through or a C corporation? So we wanted just to put on this slide is kind of just an overview of what the current tax rates are, and then what these proposed changes would be. Both what the corporate rates are, and if you've got a C corporation, there's what they call a double tax. You have the corporate rate, and if you pay that income out, you have a second layer of tax. We also wanted to factor in the QBI deduction, the 20% deduction that may or may not apply to a business, as well as this net investment tax. So on here, you can see that the first three items here is sort of the current structure here that we've got, and then the last four would be the proposed changes. And we split 4 and 5 out just because you could have some C corps, if they pay out their dividends to shareholders, who might have that new high capital gain tax, and those that would have just the sort of the present rates with it. You can see number 5 there. If you've got a double tax on the corporate tax and then have that taxed as ordinary income for the individuals, you can see we go up to over a 57% tax rate with that on a combined basis there. And then the last two just show, if you are a pass-through businesses, you've got the what the rates are, and again, that includes that new 3.8% net investment tax. So just some observations on entity selection with it, in the next slide with it. Again, the pass-through entity still probably offers the best overall option after considering the double tax of a C corporation. One item to note though, if you've got a C Corp and you pay all the income out and you're comparing that to a pass-through that does not qualify for the QBI deduction, and the shareholders of that C Corp are less than the $1 million of income, those results are pretty similar. They're almost the same. They're within a percent there. So just be aware of that. Point 3 is, again, if you've got a C Corp and it's paying out dividends to shareholders are above $1 million, that's a significant difference compared to a pass-through. You know, it's a 14% if the pass-through doesn't have the QBI deduction, and 22% if it's eligible for that deduction. And the last thing I just wanted to point out here is, again, the current cash cost, if you're a C Corp, again, is, even if I put down 25% as the rate, again, the administration initially wanted to get a 28% rate, but they realized that that was not going to really work through Congress, so they've softened it and said they'll accept a 25% rate. So some are saying if they do have a corporate rate increase, 25% may be the level that could be settled on. So that's why I use that in here. So again, a company that does not want to pay all its income out and just looking to preserve its cash flow and defer that or perhaps a dividend until later, 25% is the rate as opposed to 21%. Next slide there, Tom. Another one to thought is, you know, and it was the first polling question, is consider accelerating taxable income to a lower taxed year. So that could be accelerating into 2021 or maybe even 2020 if you got a tax return on extension. That might be beneficial, but again, you need to look at what your current marginal tax rate is under your current setting and what it would be proposed change would be based on what these, you know, some of the guidelines we've talked about. And this could involve maybe doing a change of accounting method, you know, to defer or accelerate the taxable income for that. You could have a slower depreciation method. That may be something each year, if you, instead of taking bonus depreciation, maybe you want to push off some of those deductions to a higher year, something to evaluate. Again, some of this could be done on some 2020 tax returns that you might have there on extension or looking at 2021. Again, I think it's important to model some of these changes out, look at several alternatives, the dates, look at the, you know, how much you may be saving with it. So something to look at, again, depending on your changes. Next thing we'll look at is capital gain strategies. I mentioned those are going to get changed with it. Timing is important. Again, once you find out what that change is for the capital gain change, whatever that date is, you know, somebody want to accelerate some gains to get them taxed perhaps at a lower rate, especially if they're going to be subject to that higher rate. On the other hand, once this new rate takes effect, some people are going to start maybe deferring gains, just not recognizing them because of the higher tax there. Once that new rate kicks in. A couple things to think about we put down here is a charitable remainder trust. Again, you can transfer appreciated property and not have that tax triggered. You can still get some income payout there. Again, the trust does not pay a tax on that capital gain. Any donations that you make, again, consider using appreciated property or maybe a donor advised fund. Again, you can avoid that capital gain tax. Another thought that some may have looked at is what they call an investment partnership, where you can transfer some stocks into that partnership. It's got to meet some pretty detailed rules, but you may be able to get some other securities out, but you've got to wait a 7-year period. That may you know, allow you to defer some gain recognition. Next, capital losses may be more valuable here. Again, if capital gain rates go up and you've got some losses, some people harvest some losses near the end of the year to offset some gains they have. Well, if the tax rates go up on capital gains, let's say next year, you may want to harvest those losses if you can, maybe to defer recognizing those until the new rates go into effect. Those losses may be more valuable next year, perhaps, than this year. Installment sale. One thing that some consider is that they got an installment sale is, you know, maybe they can recognize some of that gain on that installment sale and do what they call elect out of an installment sale and recognize some of that capital gain earlier. So that could be done perhaps on a 2020 tax return that you might have. That might be on extension now if you've done that, or in 2021, again, depending on the effective date of these changes here, to elect out of installment sale, do an analysis to see if it makes sense to pay some of that capital gain tax, a lower gain earlier based on the periods. The other thing is, if you already have an installment sale from several years ago, one thought would be is if you you could trigger that installment sale early by pledging or using that installment sale as security for a loan. Some of that installment sale could be triggered earlier and recognize that perhaps at a lower capital gain if you had that situation. Another one, if you have an S corporation, some may have this if you've got some earnings and profits. If you were a C corp before then, again, generally you're not taxed on distributions out of an S corp. It comes out of the AAA. But one thought is there's an election that you can pay out those earnings and profits, make an election and have those paid out earlier. So you might be able to get some of that income taxed at a lower rate by making that special election. There's also a deemed election you make that's similar with it, and you just don't even have to pay the cash out. You just get the election, you're taxed on it, and then it's contributed right back into the S corporation. So that's something to look at. But again, I think you really need to have a handle on what is your AAA, what are the earnings and profits that you have, check the new dates on when these capital gain proposals, and then look at maybe triggering that additional tax at these lower rates. Next, 1202 is, I think, something that some may be familiar with. Again, it's what they call qualified small business stock, or QSBS. Again, it's a C corporation. You're going to get taxed at the either 21% or 25% rate. So it provides you some current cash flow savings. But if you meet all the rules for this 1202, and if you hold your stock for 5 years, any gain can be 100% excluded from tax, and it could be 100% excluded even to avoid a 43% capital gain tax. You also avoid any AMT tax. Again, it needs to be, there's certain specific requirements you have to have with a qualified small business stock. So I would ask you to make sure you go through those and work with your accountant or your attorneys with it to make sure that you can qualify with it. Generally, it's not service business that fall within here. Smaller businesses needs to be the original issue of the shares from the corporation. But if you follow those rules, that could be really a significant savings for the shareholders of a Section 1202 corporation. And then the last item here, Tom, that we've got in Glenn is, I think this would really change the dynamic in any merger and acquisition transactions if we, had a higher capital gain tax. You're looking to allocate for an asset, sale of a business. Now what you're always trying to do with being the seller is try to get capital gain, goodwill or intangible value that gets a capital gain rate. Well, if those are going to be the tax the same as ordinary income, you might be willing to accept more ordinary income as a seller because it's going to be taxed at a higher rate. Well, maybe you can command a little higher price, but then the buyer is going to get a much quicker write-off on that if it's machinery and equipment, or maybe even compensation income for the selling party. So anyway, that's going to really change the dynamics of any sale of a business. So if the capital gain rate goes up to 43% from 23%, and how you plan and work with that. So that's the last item here. And again, this is just a sampling of some items that you may have with it, and as you model it moving forward and looking at some of the proposed changes here. And last Tom's got put up this slide here, just some other developments here. One thing, just want to make you aware of it. One is this FFCRA, many are familiar with, the sick and family leave credit that came out last year. This tax credit is also available for self-employed individuals. There's a form, Glenn talked about the 7200 for the ERC. There's a 7202, which is for this FFCRA leave credit for a self-employed individual. There's also some IRS guidance on the website. And then the last is this restaurant revitalization grant we had talked about before. We had a session on this and had some materials. That application process actually ran the last 3 to 4 weeks and ended earlier this week. So most funds have been committed, and funding will be unavailable or underway here from the SBA in the next week or so. Unsure if there'll be any additional funding made available for Congress for some of the restaurants that did not qualify with it. So.
Well, thanks, Jim. That was a lot. I don't think you took a breath there for about 5 minutes, so that was impressive. I've seen that on a movie before, but never in a presentation. So I think in summary, the planning needs to start early, right? And remember too that bonus depreciation and some of these other existing tax laws we have in place are going to start to phase out. So right. Make sure you take into account those phase outs that are coming, and our best estimate of some of these other projected changes and how they're going to affect you. So I think that pretty much wraps everything up. Glenn, did you have any final thoughts about the American Families Act?
Yeah, the only thing you just said it, but 2022, I think I've got this right. 2022 is the last year of 100% bonus depreciation, and it's also pretty good chance we're going to have higher tax rates. So that could be the time to spend money on CapEx. So
good.
Right.
Well, listen, on behalf of Glenn and Jim and our entire team that helped put this together, we want to thank you for your participation today. Remember, directly after the webinar, you'll get a survey. You'll need to fill that out, especially those that want to get some CPE. But we invite your comments and observations so that we can offer the best programming going forward. So thank you very much and have a great day.
Thank
thanks,
you.
everyone.
Bye.